OPEC, which controls 40% of the oil market, kept output unchanged to remain competitive.
In the interest of restoring market equilibrium, the conference decided to maintain the production level of 30 million barrels a day as was agreed in December 2011.
In the meantime, African oil-producing countries are at risk of losing revenue and investment.
They are countries whose economies depend almost exclusively on their oil production, and the fact that oil prices fall means that they see an almost direct reduction in their export revenues.
According to auditing firm KPMG, there are over 30 oil and gas projects awaiting investment decisions in Africa. But due to current lows in the oil price, many of these could be scrapped or postponed. Nigeria will be the hardest hit as it depends on oil for 80% of government revenue and 95% of exports. Libya, Angola and Algeria will also be affected, with their economies depending on oil for more than 50% of government and export revenue. Ghana also depends on oil for 30% of government revenue and 20% of exports. And with the US upping its production, resources from producers such as Nigeria and Angola might not be needed. Gumede says reports show that by 2030, the US and other developed countries might not need oil from foreign markets such as Africa. It's therefore imperative for the continent to diversify its economies away from oil.